Banking is the invisible hand that guides economies, fuels dreams, and shapes our daily lives. From bartering goats to digital transactions, the story of banking is a journey through time. It's about the Sumerian temples, Roman financial empires, and Renaissance merchants who revolutionized trade. We'll uncover pivotal moments from the invention of paper money to the rise of central banks and the digital revolution. Along the way, we'll meet visionary thinkers, ruthless tycoons, and ordinary individuals navigating the world of finance. Before money, bartering was the norm. Barter worked for small communities but was inefficient for larger societies. The need for a common medium of exchange led to the advent of money. Early forms of money included precious metals like gold and silver. Carrying large amounts of metal was cumbersome and dangerous. This need for safe storage led to the emergence of the first banks. Banking's evolution is a testament to human innovation and economic advancement. It has shaped trade routes, influenced empires, and fueled cultural movements. From the Medici family to the Industrial Revolution, banking has played a pivotal role. As we enter a new era of digital currencies and blockchain, banking continues to evolve. Understanding banking's history helps us appreciate the forces shaping our financial lives. Imagine a world without money, relying solely on barter. Barter thrived in early agricultural societies, fostering community and trust. Transactions were social interactions, strengthening communal bonds. However, barter had limitations, paving the way for money and banking. As societies grew, the barter system struggled to keep pace. Barter faced significant hurdles as societies expanded. The double coincidence of wants was a major drawback. Subjective value made fair trades difficult. Barter was impractical for large-scale transactions and long-distance trade. A more efficient system was needed, leading to the invention of money. Money revolutionized trade and economic exchange. The need for a practical medium of exchange led to commodity money. Cattle and grain were common forms of commodity money. Transporting livestock and grain was cumbersome and risky. Precious metals like gold and silver became ideal mediums of exchange. Early coins simplified trade and laid the foundation for financial systems. Standardized currency facilitated economic growth. Coinage brought the need for safe storage of wealth. Temples in ancient Mesopotamia became the first banks. People entrusted their wealth to temples for safekeeping. Temples facilitated trade by holding deposits and honoring withdrawals. Lending and interest practices emerged in these early banking systems. These early banks laid the groundwork for modern finance. Mesopotamia, the cradle of civilization, saw the birth of banking. The Sumerians established a system of trade with standardized currency. Temples served as the first banks, safeguarding wealth. Trust and security became fundamental pillars of financial systems. This marked a pivotal step in the evolution of banking. Mesopotamian temples actively engaged in financial transactions. People received clay tablets as receipts for their deposits. Temples offered loans with interest, fostering economic activity. Interest rates varied based on loan type and economic conditions. This system laid the groundwork for credit markets and investment. Early banking practices shaped our global economy. As banking grew, so did the need for regulation. Hammurabi's code included financial regulations to prevent fraud. Loans and deposits had to be documented in writing. Maximum interest rates were established to prevent usury. The Code of Hammurabi influenced law and commerce in the ancient Near East. Written contracts and legal protections laid the foundation for modern banking. Mesopotamian innovations laid the foundation for modern finance. Banking evolved to encompass lending, investment, and trade facilitation. Trust, security, and efficient capital allocation remain core principles. Greeks, Romans, and other civilizations built upon these early practices. Ancient Mesopotamians' quest for economic progress shaped our financial world. In ancient Greece, the agora was the heart of economic life. Money changers or trapezites facilitated currency exchange. Each city-state minted its own coins, requiring exchange services. Trapezites ensured smooth transactions across different currencies. They played a crucial role in the Greek economy, bridging currency gaps. As trade flourished and the Athenian Empire expanded, the role of trapezites evolved beyond simple money changing. They began to offer a wider range of financial services, blurring the lines between money changers and early bankers. Their operations grew in scale and complexity, leading to the establishment of formal banking houses that played an increasingly vital role in the Athenian economy. These early banks, often family-run businesses, accepted deposits from wealthy citizens, merchants, and even temples, providing a safe haven for their accumulated wealth. They issued letters of credit, early forms of bank drafts, which allowed merchants to conduct business transactions without having to transport large sums of money, mitigating the risks associated with travel and theft. Moreover, trapezites began engaging in lending activities, providing credit to merchants, ship owners, and even the Athenian state itself. They financed trading expeditions, public works projects, and even funded wars, wielding considerable economic influence within Athenian society. However, this burgeoning financial sector was not without its risks. The inherent volatility of maritime trade, coupled with the occasional outbreak of war, could lead to financial instability. Bank failures, while not as widespread as in later eras, did occur, highlighting the need for greater regulation and oversight of banking practices. Section 3. Roman Finance, from humble Argentarii to financial empires. As the Roman Republic rose to prominence, conquering vast territories and establishing a dominant presence in the Mediterranean, it inherited and adapted many aspects of Greek culture, including its financial practices. However, the Romans, known for their pragmatism, legal acumen, and penchant for large-scale organization, would leave their own indelible mark on the world of banking. In the early days of the Republic, money lending was a relatively informal affair, often conducted by individuals known as Argentarii, who operated from stalls or benches in the Roman Forum. These early financiers provided basic banking services to the growing populace, exchanging currencies, offering loans, and acting as money changers for a fee. However, as the Roman economy expanded, fueled by conquests and trade, so too did the demand for more sophisticated financial services. The Argentarii, seizing this opportunity, gradually evolved into powerful banking families, establishing formal banking houses that wielded considerable economic and political influence. These Roman bankers, often freedmen or descendants of freedmen, amassed vast fortunes by financing large-scale ventures, such as mining operations, shipping enterprises, and even gladiatorial games. They provided loans to ambitious politicians, financed public works projects, and managed the financial affairs of wealthy Romans, solidifying their position as indispensable players in the Roman economy. Section 4. The Pax Romana and the expansion of banking credit across the empire. The advent of the Pax Romana, a period of unprecedented peace and prosperity that dawned with the reign of Augustus Caesar, ushered in a golden age for Roman banking. With stability restored to the empire, trade flourished, and the demand for credit soared. Roman bankers, with their extensive networks and financial acumen, played a pivotal role in facilitating this economic expansion. Banking houses established branches throughout the empire, extending their reach from the bustling port of Ostia to the distant provinces of Gaul and Britannia. They financed the construction of roads, aqueducts, and amphitheaters, fueling infrastructure projects that connected the far-flung corners of the Roman world. Roman law, with its emphasis on contracts and the enforcement of debt, provided a stable framework for banking activities. The legal recognition of deposit banking and the development of sophisticated credit instruments, such as bills of exchange, facilitated long-distance trade and investment. However, this era of prosperity also sowed the seeds of future financial instability. The concentration of wealth in the hands of a few powerful banking families, coupled with the risky nature of some investments, created systemic vulnerabilities. The Roman Empire, despite its grandeur and enduring legacy, would eventually succumb to a confluence of factors, including economic decline and political instability, demonstrating the intricate link between the health of a nation's financial system and its overall well-being. Section 1. Medieval Italy, a fertile ground for finance. As Europe emerged from the Dark Ages, Italian city-states became a crucible of economic transformation. Powerful merchant families and strategic trade routes made Italy a hub for commerce. The bustling ports of Venice, Genoa, and Pisa thrived with goods from the east. This surge in trade created a demand for sophisticated financial services. Italian merchants established banking houses, rivaling European royalty. They navigated complex laws and innovated despite the church's prohibition of usury. These challenges spurred groundbreaking innovations in banking practices. Section 2. The rise of the Medici, from merchants to masters of finance. No family embodies the rise of Italian banking more than the Medici of Florence. From humble beginnings as wool merchants and traders, they ascended to become the most powerful bankers in Europe, their influence extending far beyond the realm of finance to encompass politics, art, and even the papacy. The Medici's ascent began in the 14th century under the astute leadership of Giovanni di Bicci de' Medici, who recognized the lucrative potential of banking and established the family's first bank in 1397. Giovanni's shrewd business sense, coupled with his connections to powerful Florentine families, enabled the bank to thrive, financing trade, lending to rulers, and managing the finances of wealthy individuals. His son, Cosimo de' Medici, inherited not only his father's business acumen, but also a keen understanding of the intricate relationship between finance and power. Cosimo expanded the Medici Bank into a vast international network, with branches in major European cities including Rome, Venice, Geneva, and Bruges. Recognizing the importance of cultivating relationships with those in power, Cosimo shrewdly offered loans to popes, kings, and even rival city-states, leveraging these financial ties to exert considerable political influence. He became the de facto ruler of Florence, though he preferred to wield power from behind the scenes, using his wealth and connections to shape the city's destiny. Section 3. Letters of credit and double-entry bookkeeping. Innovations that transformed banking. The Medici family transformed banking with letters of credit and double-entry bookkeeping, revolutionizing trade and accounting. Letters of credit made international trade safer and more efficient. Double-entry bookkeeping provided a transparent view of financial health. These innovations enabled better financial management and decision-making. Section 4. The power and peril of patronage, the Medici legacy, and the limits of financial influence. The Medici transformed Florence into a center of art and culture through their immense wealth and patronage. They commissioned masterpieces from artists like Michelangelo, Leonardo da Vinci, and Botticelli. Their patronage fueled the Renaissance's creative spirit. The Medici also used their wealth to enhance political power and support public works. They secured the papacy for family members, including Pope Leo X. However, their wealth bred resentment and political instability. The Medici legacy shows that financial power has its limits. In 1694, the Bank of England was born, marking a pivotal moment in financial history. This event established the central bank, shaping global finance for centuries. England was transforming, with financial strain from wars. The Glorious Revolution had ushered in a constitutional monarchy. Wars with France strained finances. Traditional funding sources were insufficient. William Paterson proposed a national bank to lend money to the government. His idea gained traction among Parliament and merchants. In 1694, the Bank of England was established. Its creation marked a watershed moment in finance. The Bank of England revolutionized transactions with paper money, laying the groundwork for the modern financial system. Early banknotes represented a claim on the bank's gold and silver reserves. The issuance of banknotes had a profound impact on the English economy. It injected liquidity, making it easier for businesses to obtain credit and expand. The establishment of the Bank of England set a precedent that would be emulated by nations across Europe and beyond. Central banks, modeled after the Bank of England, emerged as powerful institutions, entrusted with the critical responsibility of managing national debt, ensuring financial stability, and fostering economic growth. One of the primary functions of central banks was to act as a lender of last resort, providing emergency funding to commercial banks facing liquidity crises. This role proved crucial in preventing widespread bank runs and financial panics, which could cripple economies and erode public confidence in the financial system. Central banks also played a key role in managing national debt. By issuing government bonds and other debt instruments, central banks provided a mechanism for governments to raise funds for infrastructure projects, social programs, and other expenditures. Through their control over interest rates, central banks could influence the cost of borrowing for both governments and businesses, impacting investment levels and overall economic activity. Moreover, central banks assumed the responsibility of regulating the money supply, a delicate balancing act aimed at controlling inflation while ensuring sufficient liquidity to support economic growth. By adjusting interest rates, reserve requirements for commercial banks, and other monetary policy tools, central banks sought to maintain price stability and foster sustainable economic expansion. Section 4. A catalyst for change, paper money, and the transformation of global trade. The adoption of paper money, facilitated by central banks, transformed global trade. Merchants could now finance international transactions with ease and efficiency. Letters of credit reduced risk and increased confidence in international trade. Bills of exchange streamlined debt settlement between merchants. Trade expanded, creating new markets and fostering economic interdependence. The volume of goods traded internationally surged. The rise of paper money had its critics. Some argued it fueled inflation and devalued currency. Others worried about financial instability without tangible backing. Despite concerns, paper money laid the groundwork for modern finance. It marked a turning point in finance, showcasing human ingenuity. Section 1. The rise of financial giants, investment banking, and the Industrial Revolution. The Industrial Revolution transformed societies with technological innovation and economic expansion. Inventions like the steam engine and telegraph fueled mass production and urbanization. Investment banks emerged, underwriting securities and facilitating mergers. They raised capital for railroads and factories, driving economic growth. Section 2. Economic upheavals and the birth of regulation, the Great Depression and the Federal Reserve. The Industrial Revolution's unbridled capitalism fueled growth but also instability. Booms and busts led to unemployment, business failures, and social unrest. The 1929 Wall Street crash and Great Depression exposed financial vulnerabilities. Bank failures and credit crunches plunged the global economy into hardship. The Great Depression spurred reforms to restore financial stability. The Federal Reserve System was created in 1913 to prevent future crises. The Fed provided a more elastic currency and regulated the banking system. The Fed's creation marked a turning point in U.S. financial history. The Great Depression highlighted the need for prudent regulation. Reforms aimed to balance economic dynamism with protection against systemic risks. Section 3. The Digital Revolution, from ATMs to cryptocurrencies, banking at our fingertips. The digital revolution transformed banking with ATMs, online banking, and mobile apps, offering unprecedented convenience and accessibility. ATMs in the 1960s, online banking in the 1990s, and mobile apps in the 2000s revolutionized financial services. Today, cryptocurrencies like Bitcoin represent the latest evolution in this ongoing digital transformation. Section 4. The Blockchain Frontier, Decentralization, and the Future of Finance. Blockchain technology is disrupting finance, challenging traditional banking and currency. Its transparency, security, and immutability promise a revolution. Cryptocurrencies like Bitcoin and Ethereum offer decentralized alternatives to fiat currencies, gaining traction as investment assets. The rise of blockchain sparks debate on the future of money and traditional financial institutions. Proponents highlight transparency and efficiency, while skeptics worry about volatility and regulation challenges. Governments seek to balance innovation with consumer protection and financial stability. The digital revolution in banking is still unfolding, reshaping the financial landscape. Section 1. The unstoppable evolution of banking. From rudimentary barter systems to sophisticated digital platforms, banking has constantly adapted and innovated. From safeguarding valuables in ancient temples to a complex global network, banking touches every aspect of our lives. It's a story of ingenuity and progress. Each era leaves its mark, shaping our economic interactions. From Sumerian priests to Medici financiers, banking has fueled empires and cultural movements. The digital revolution is transforming finance, creating new opportunities and challenges. Section 2. Shaping a more inclusive and secure financial future. As we stand at the cusp of this new era in finance, marked by digital currencies, artificial intelligence, and decentralized financial systems, it's imperative to reflect on the lessons learned from centuries of financial innovation, both its triumphs and its missteps. The financial crises of the past, from the tulip mania of the 17th century to the global financial crisis of 2008, serve as stark reminders that even the most sophisticated financial systems are not immune to instability, speculation, and the consequences of unchecked greed. As we embrace the transformative potential of new technologies, we must do so with a keen awareness of the risks involved and a commitment to building a more resilient and inclusive financial system. The future of banking will be shaped by how we address these challenges and harness the power of innovation to serve the needs of all members of society. This requires fostering greater financial literacy, expanding access to financial services for the unbanked and underbanked populations, and promoting responsible innovation that prioritizes financial stability, consumer protection, and ethical considerations. The democratization of finance, facilitated by technology and driven by a commitment to inclusivity, has the potential to empower individuals, foster entrepreneurship, and create a more equitable and sustainable world. By learning from the mistakes of the past and embracing the opportunities of the present, we can shape a financial future that benefits not just a privileged few, but all members of the global community. The story of banking, as we've seen, is far from over. It's a story that continues to unfold with each passing day, written by the countless individuals who interact with, shape, and are shaped by the evolving world of finance. By understanding the forces that have driven this evolution, we can become more informed participants in this ongoing narrative, contributing to a future where finance serves as a powerful tool for progress, prosperity, and shared well-being.